Welcome back. This is the Something Venture podcast. I am Kent Lindstrom. I am your host. My guest today, Winter Mead. How are you doing?
Great. Thanks, Ken, for having me on.
So this is going to be great. Winter has, if you look at Silicon Valley, there's people who do unique things. There's a lot of people who do what I do. I run a fund called 8-Bit Capital that invests in startups. There's people who invest in companies like mine and in funds like mine. Those are called limited partners or LPs. And there's thousands of what I do, general partners, probably tens of thousands of LPs. But there's people who have very particular spots in the ecosystem that are different from those two things, and Winter is one of them. He is the founder of Coolwater, and I'll have him tell you what that is. But first went to Harvard, then went to Hall Capital, then worked at Sapphire Ventures before founding Coolwater. And I thought we would unpack, just explain to people what those things are. I think Harvard, most people probably have a pretty good sense. School in Boston, right?
Place where you park boats.
Exactly. So Hall Capital is a family office. Is that right?
Yeah, they're a wealth manager. So when I was there, and maybe the story has changed a little bit since 10, 15 years ago, but they manage capital on behalf of ultra high net worth individuals. So, some people would call that a multi-family office. Like a family office is a high net worth individual that has enough money where they have a team that manages their money. And some people elect to have a wealth manager manage that. And so Hall had, 100 plus clients that were ultra high net worth individuals. And, we were making investment recommendations to those families across asset classes, venture capital, private equity, public equities, real assets, real estate. But they also manage capital on behalf of endowments and foundations as well.
And this happens a lot, right? Where a family gets really rich, smelting iron or whatever the heck they're doing. They put together a group of people who manage that money. One guy does the public equity, someone else does the private equity, somebody does the real estate. And then they realize, well, they've built up this function. If they can do it with, $500 million, they can do it with $1 billion, and their friend brings their money in, and all of a sudden they're managing 100 different fortunes. Is that roughly how it works?
That's what I've seen as the pattern. Right. Yeah. Like you want to dial it in, you want to make sure it works for yourself. And then I think, similar to an expansion plan for any other business, right? Yeah. Like if you build the Chick-fil-A once, right, then, right. The second Chick-fil-A is probably easier than the first one.
Yeah.
So I think that's exactly how I've seen it play out. Yeah. And then, like family offices, sometimes it's more formal, right? Where you're building an actual wealth management firm, or another model it's referred to is called outsourced chief investment officer, like OCIO. But sometimes it's just like a loose consortium of family offices that, like to talk about deals together or, co-invest together. Yeah. So, but in this case, Hall, it's a very formal, OCIO that, again, like manage capital for some very, well-known people and well-known endowments and foundations. So it's a much more formal investment shop.
Yeah, it's funny. I guess it doesn't occur to a lot of people that when you become really wealthy, and by the way, nobody's going to feel sorry for you, but you become really, really wealthy and you have $900 million, you don't just put it at Fidelity. Like you need like people and things and teams of people to file your taxes. And again, shed no tears, but it is a bit of a thing.
Yeah. This is where we cut to the world's tiniest violin.
Yeah, exactly. Like they say, you want to be, you want to be really rich, but not famous. You don't want to be running around with bodyguards like Mark Zuckerberg or, some of the Bitcoin guys.
Yeah. When I was helping teach at Stanford for a number of years, like a lot of the people that would come in who were tech luminaries had bodyguards.
Yeah. Yeah. It's crazy. I went to a very famous venture capital firm once, when I had a company, I'd go visit, and, a couple of the partners were billionaires, famous in Silicon Valley, but not globally. And I realized there's an admin, but there's like this really big, fit-looking guy sitting at a desk, just hanging out. Doesn't seem to be helping me with anything. And I'm like, hey, he's wearing a jacket, and you're like, oh shit, there's like a security guy here for the billionaires. So you go to Sapphire Ventures, which is even higher profile. And what are they similar? Or they're doing something even a little more broad in the industry?
Yeah, different type of investment firm. I would characterize them more as a venture capital firm, right?
Hmm.
That's, largely connected to a corporate, SAP. So, SAP is a technology company that's been around for decades, so they have a higher profile brand. And then VC firms generally, right? I'd say especially in the last decade, there's been a big push towards building a brand and being more kind of prominent in the media circles. So, we spent a lot of time, yeah, probably mid 2010s, spent a lot of time kind of thinking about media strategy and how we, talk about the different brands.
Yeah.
Yeah, they have a couple of different VC firm strategies, a growth fund, for example, a sports fund, for example, and they also have a fund to fund strategy called Sapphire Partners that invests into venture capital funds. So both at Hall and at Sapphire, you would have teams focused on investing into funds, right? Like the limited partners, the LPs investing into funds.
Right.
But the difference at Sapphire, right? Like you had a bigger team actually doing direct investments.
Right.
And at Hall, they would, I think evaluate direct investments and co-investments, especially on the private equity side. But at, Sapphire, I want to say they have, 50-person team that focuses on like
Wow.
investing directly into growth stage companies. So again, it's an
Yeah.
investment firm, but it's a different type of investment firm, more
Yeah.
like a growth VC firm than a, OCIO or wealth management
Yeah.
firm.
So you really have a front row seat. I mean, you're seeing presumably the best of the best of the emerging fund managers are coming to both Sapphire and Hall, and you see all this, and you've got a pretty sweet job, I would think, working there. And at some point, you decide, nope, I'm going to go start something. I'm going to be an entrepreneur. What do you what do you see? Like what's it makes you say, nope, there's something missing in the market. I need to get out there and do my own thing and solve this problem.
It's more of an itch than anything else. I think, yeah, like if you're an LP and you're working for an existing stable investment firm, um, there is a path, like a very logical path that says this is stable. I could do this for the next couple decades. Like, why not?
Yeah.
But sometimes, I think there's an itch to actually, establish a legacy and like create change, right? Drive impact. And yeah, I think like the pattern historically, right, is the people that are kind of driving that forward um, have a certain, value system or beliefs that they kind of want to see the world a certain way.
Yeah.
Um, I've been a company builder for as long as I can remember. I like grew up on a farm, ran companies. They weren't necessarily super sophisticated companies, but even when I was, working at Hall and SAP, like I ran, a food logistics company on the side,
Really?
that's been profitable for the last 15 years. So from that perspective, it was like that was kind of scratching the itch a little bit.
Yeah.
Like I think when I was an LP, and don't get me wrong, like, I put in 80, 100-hour plus weeks, like every single week, for 8 straight years.
Yeah.
But like you could still, right, like if you're excited about something, like you could still find the energy to kind of like
Yeah.
invest into company building. But yeah, I think the itch for me was kind of seeing, what it meant, like the writing on the wall of like what it meant to be an LP. And I felt like after 50 LP investments, I had a certain pattern, like I had a certain skill set, right?
Hmm.
And that was like underwriting fund managers. And, again, like the decision to, do you do this for the next 20 years of your life, or is there a higher calling, right?
Yeah.
Is there something else that should exist in the ecosystem, right? And who's going to build that? And so I do think there's a couple of years where I kind of looked around and, waited for someone else to kind of build things I was thinking about, right? It's like you're like, oh, I have this great idea. And then you go on the internet and you like look it up and you're like, oh man, like 400 people like have had that same
There's 10
idea,
of them.
right?
Yeah. Yeah.
Yeah, you're like, oh, I've got this great idea for the kitchen to like make my, cooking experience easier. And those like you go on to whatever Williams Sonoma and like,
Yep.
there's four different
Right.
brands with that exact item. You're like, how does anyone think of that?
Right.
But I think the concept was, like a platform to support emerging managers, right? What felt like there was a gap in the market for this. Again, it's a very specialized part of the market. Like you're in venture capital or private equity, which is already kind of like in alternatives, which, historically has been kind of a, smaller part of the market, less kind of known. And within alternatives, right, like venture used to be embedded into private equity. So you got alternatives, private equity, then venture. And then there's this gap where you have limited partners, LPs, investing into VC firms. And if you look at the data, the majority of that capital goes into well-known firms
Hmm.
that have been around for decades. And so, if you're sitting in your ivory tower seat at an LP shop, and, again, if you have lots of money, like the easiest way to get people to knock on your door is to just like wave a flag and say, I have lots of money.
Right.
And then people just come like pouring in, right? Like, I'm a new fund of funds, right? Like put an
Hmm.
article in TechCrunch or something, and a bunch of people kind of come knocking. And so, we kind of did that. Like I said, like the building the brand exercise was more of like, okay, how do we get more and more managers to come to us versus us having to like, hunt down the managers. Um,
Yeah.
uh,
Well, I have a question for you before we proceed with this. This is really interesting, but I got to say, first of all, it is not typical. A lot of people go into the job of working for a foundation or investment management. I mean, you don't go in there because you're. Most people aren't running a food logistics business on the side. Like, just to be clear, like that's a little bit of an outlier state for what you're doing. Um,
Well, that gave me the sentiment for, I think, business building. But
yeah,
again, it kind of felt more of it was almost like you're a disingenuous CEO because you're not doing it full time,
that's
right? So
right.
if you're talking to another founder, like a lot of founders are all in on like one thing,
That's right.
right? And so if you're kind of doing it on the side with a salary, like it's a different experience than if like your whole career kind of like and your whole like well-being kind of relies on you being successful.
Right.
And so there kind of was that, okay, I'm doing this, scratching an itch, but it's not the full itch. And then, yeah, to kind of round out the last story, there's kind of this insight, working at an LP shop, again, like kind of being in the ivory tower, which was like emerging managers aren't being supported. And there's an institutional gap between like where dollars are being allocated and where support was actually needed.
Hmm.
And I kind of like, I was fortunate to spend time, on 79 investment processes, allocating capital into 79 different funds.
Yeah.
Right. And so both private equity and venture capital. And again, like you kind of see this pattern, but a lot of the time, if you're writing even a very large check, right, like maybe you walk around with a little bit more swagger, right, because you're such a big capital allocator, but like you you aren't actually contributing to the build process, right? And it felt like what I saw was people coming in and I'd be like, wow, that's very polished, like what did you do before then? Oh, wow, you had like a 15, 20-year career. Like you've been so successful up to date. Like this is your first fund. And then there was, again, the disconnect between like what I thought was talent and what I thought was high potential and what I thought was going to be high performance, right? That's what investors care about,
Yep.
like high performance and where the capital was actually going. And so I think that was like the insight where I'm like, why isn't someone creating something to support these emerging managers? And there's a
Yeah.
couple of emerging manager fund of funds, but they were just capital allocators. They weren't like co-builders with these managers. They didn't create kind of the ability to like add a lot of value to these managers. And so
Yeah.
again, like they were fund of funds, but they weren't value added platforms thinking about it in a different way, which was like value add first. A
Right.
lot of the fund of funds were like capital allocation first. And so I kind of flipped it on its head and I said, if you could redefine what it meant to be an LP, right? Some people have redefined what it means to be a VC.
Right.
Like YC redefined what it meant to be a VC. A couple of years later, Andreessen kind of redefined what it meant to be a VC, right? Maybe a couple of years later, like Studios kind of redefined what it meant to be a VC.
Yeah.
And so you kind of have like this redefinition of venture capital like every 5 years, but no one's like redefined what it means to be a limited partner, like an
Right.
LP, like the money behind the money. Like who's redefining that?
Yeah.
You're not. You're just like a lot of it was kind of like sort of fitting into the mold of I'm going to be a capital allocator. I'm going to write a check. My role is to do due diligence on your firm, Kent, 8-bit. You give me the data room. I'll do the due diligence in a black box. I'll come back with a decision, kind of yes or no. And there's no transparency about the process. There's no kind of understanding of like what is going on here, right? Like, and then if you get a yes, you're elated, you're not any smarter. If you get a no, you're defeated, you're not any smarter. And so there wasn't like that, right? Like you've had Fred Wilson and Brad Feld and Mark Schuster and all these people writing blogs and kind of making, your podcast and other podcasts, making venture capital more transparent. But again, like there wasn't a platform to make this kind of LP GP interface, that dynamic between like the people that give VCs money right? Like there wasn't a platform to like better understand that world.
Right.
And so when we were at Sapphire, we created hashtag OpenLP, right? But that was an aggregator of content.
Hmm.
Like that wasn't built to be a generator of content, which is different. People are writing about different things, and we're kind of saying, hey, like we'll pull that into like a hashtag, right? And so stuff starts flowing, into a feed that's relevant to like LPGP,
Yeah.
but it wasn't like it wasn't a creator of a generator of content. So that's like when I wrote, first book, the second book, the idea like building this kind of training academy. The idea was like, okay, great, like aggregator, good, but what about like generator or training,
Right.
right? Or that next step that's like deeper to help with implementation. And so it's like more like again, I think hashtag OpenLP has been, decently successful, but I think Coolwater was kind of that next step of like, how do you actually substantively help implement and help co-build with these managers? Because
Yeah.
it didn't seem like what the feedback for years after we did that was, great, I'm reading these things, I'm smarter, but I'm not actually better. And like, I can't pull it all together still, right?
Yeah.
There's still that gap between like, I've got a bunch of things, like disparate pieces of information, like it's all on my desk, but I can't actually lay out the collage so that it's logical.
Yeah.
So that was me kind of building like the book and like sequencing out stuff and being like, hey, here's the 1 through 10 steps. Where if you run this 1 through 10 steps, again, like this is just one way to do it. There's multiple ways to do it. I'm not
Right.
saying this is a fund in the box, like the only way to do it. But if you run these 10 steps, I think you have a higher probability of getting into market faster, right? Knowing the things you need to manage and having like a higher chance at, higher probability of being successful on the fundraising trail,
Yep.
right? Because you're not trying to figure out all this stuff at the same time, doing things that are incredibly hard, investing well, fundraising,
Yep.
right? Those are the things as a GP you should be spending time on. And if you're spending time on all this other disparate information that really doesn't contribute to kind of the alpha that LPs want,
Yep.
then you're kind of wasting your time.
Yeah, and I should mention from the Overachievement Chronicles here, Winter's written 2 books, How to Raise a Venture Capital Fund and How to Set Up a Venture Capital Fund. So you really have it in your DNA, even before you start, I think it's before you start, to really help people understand and help fund managers get there quicker, wherever there is, right?
Yeah. And that's, again, there's kind of so then you have like the aggregator piece, right? Like hashtag OpenLP. Then you have the generator piece, like the books, let's call it.
Yeah.
Like here's more content. There might be like a third bucket, which is like implementation.
Yeah.
Right. And like if you've ever built a business, it's not just like, okay, great, let me pick up this book, read the book. Now I'm ready to go. Right. Like I'm ready to build this business.
Yeah.
It's different. It's definitely different. It's like you have to take that information, package it, talk about it, iterate on it, and yeah, eventually kind of turn that into like an actual fund and like
Yeah.
implement.
And as you see all these emerging managers, what I guess I would ask, why should an LP care about emerging managers? In the first place, it's kind of complicated, and it's just easier to invest in, Sequoia and Andreessen. And it seems like there's a bit of an issue. Venture has a really weird feedback cycle in terms of the finance world. So if you're an options trader and you say, hey, the yen's going to fall against the dollar, and the next day you're like, oh, I was wrong, right? It's like you're not very good at this. But in venture, you invest, and then years go by, and maybe things work and maybe they don't. It takes a while to realize if you're good. And I think something that emerges out of that is there's people who are good in a room who raise funds. There'll be some fund, and you're like, what? I've never heard of this person. I don't know what they've done. I don't understand their portfolio. But then you meet them and you realize they're just an excellent salesperson, and they're good in a room, and they have a fund, and some person who's really well connected to a lot of really interesting people in AI or something struggles since they're like not a natural salesperson. So I guess I would ask you, what is the thing, or what is the kind of set of things that you said, emerging managers are really need to get better at these things in order to succeed, in order to connect appropriately with an LP?
Yeah, I think maybe I'll answer the question I want to answer there. So I agree with you. There's like people that raise funds. There's a few ways. Like Capital Network is like if you have a great capital network, you could probably raise a fund. To your point, like another way to do it, like if you're a great salesperson, even if you don't have a great capital network, like you will have a great capital network, right? Like again, like going like what are the pillars that you're kind of doing if you're building a venture capital fund? Investing, portfolio management, right? Fund management, kind of like back office,
Yep.
fundraising, right? Like there's these different pillars. And so what, again, this is another insight that I had, which was like, wait a minute, some of these people are raising capital and I don't think they're the greatest investors. And again, I would even break out investor versus portfolio manager, right? Like you invest, you can be a good investor and you can make money kind of one off. But as a fund manager, your job changes. Like you become a fiduciary to the fund and you're trying to make money at the fund level. And of course, it's like you make money at the fund level by making money at the deal level, but you're building kind of a portfolio, right? Like you become a portfolio manager, which is a different skill set than just an investor.
Right.
And so, yeah, I think that was kind of an insight. And yeah, I was kind of saying, okay, great. With Coolwater, how do you kind of bring some of these kind of bad fundraisers, up? And like, how do you kind of train them on some of these different concepts, some of these different pillars? And how do you help them like, sometimes it's just a matter of like packaging the fund product, right? Like what should your pitch actually be? Right. Or what should, you actually be raising here? And a lot of times, again, if you listen to thousands of pitches, you start to see patterns. Like some people didn't even know what their superpower was, right? Like you listen to all these LP podcasts and they're like, what's your special sauce? What's your superpower? What's your edge? Right? Like all these kind of terms that LPs use where they're trying to be like, what's your differentiator? A lot of times, like I'd be talking to managers and they'd be talking and be like, I don't know how you made so much money. Like it's almost like you're lucky, but it's like, right. Like the LP bets on repeatability, right? Like if you're going to raise a VC fund, they're betting on something that you can do over and over again. Right. And what I noticed, so like a lot of emerging managers didn't even know what that they were doing as their special sauce over and over again. It's like, okay, well, let me be your coach or like help you objectively understand why you're so great, right? Like, you look at someone, they're super athletic. It's like, what sport should you be playing, right?
Right.
If you're 6'7", 6'10", like what sport should you be playing? If you're like 5'3", like what sport should you be playing, right? Like if you're good on skates, like what sport? And so you're trying to like say like, okay, maybe you shouldn't be playing baseball or maybe you shouldn't be playing basketball. It's like, have you thought about it this way, right? So I think that was part of it. It's like helping like package the fund product. But yeah, like you'd have all these VCs kind of coming to market and a lot of them, I'd say the two most common forms of getting backed historically have been you spin out of a top firm.
Yep.
And the reason that's easy to back is because your track record is easily verifiable. And the people that allocate the most amount of money are most likely already involved in that existing established VC firm.
Right.
And so they already have a relationship with you.
Yep.
Right. And so if you're kind of like, oh, this VC firm got too big, they're now doing growth, I want to do early. I've been with this VC firm for 15 years. They used to do early. I'm going to go back to my roots and like do early again.
Yep.
Right. And so you kind of jump out and you're kind of a known entity.
It's a great story too. It just sounds true. It just sounds right.
Yeah. And so it's just like that type of story resonates. And the other kind of big story is like, yeah, I've been part of like a hyper growth machine, right? As a founder or like an early employee, I've scaled up. This company is now one of like the behemoths in Silicon Valley or greater kind of tech ecosystem. I'm now leaving. I have great sourcing. I know all the engineers there. I know all the people spinning out. I've got great connections. I was the founder. I'm connected to the founders. Like that story as well really resonates with kind of like established LPs. Yeah. And so like the LPs kind of back those two stories, I'd say the most historically. Yeah. But in the past 10 years, right, like you've had this proliferation of funds. And so people from different backgrounds, right? And again, like then you had to dig deeper and say like, okay, why are they raising? And that's like, they're super connected to capital already, right? Son or daughter of someone that's super wealthy, or they're personally wealthy and kind of anchoring their own fund to kind of kick it off and jumpstart it and be super aligned, with the LPs that would come on as follow-on investors. They're super savvy as salespeople, right? Which again, sales is different than investing, right? Like you're selling something. Fundraising is a different pillar than investing, right? And so like if you're good at both, that's definitely awesome because hopefully like then you'll raise money and make people money.
Yep.
But if you just raise money, I think, what we've seen, I think in the last 2 to 3 years, or what we may be seeing, right? Like the data isn't kind of for certain yet, is a lot of people, and that was more market driven, maybe even than like sales talent driven. So it was more like timing of, zero interest rate environment, people going out, and it was just that people wanted to like put money into stuff that they thought was going to be like higher yielding.
Yep.
And I think what a lot of LPs, especially newer LPs, maybe misjudged was venture takes a long time to create value,
Right.
right? Like the J curve is, 3 to 5 years long. It's not a year. And so all
Right.
of a sudden, like you kind of see all these like quick markups. People are going back to raise, in a zero interest rate environment as fast as possible. So all the like the fund timelines got super compressed. You weren't even like a good salesperson, right? I even
Right.
argue
Right.
like some people weren't even good salespeople in the last like
Hmm.
3 years of fundraising. They just were in the right market timing, right?
Yeah.
And so if you're a good salesperson, right, you're packaging the product well and you're selling it and you're hitting on the right points and you're running the sequencing correctly. And yeah, you're able to like rinse and repeat, but it definitely helps to have a capital network as well. And then, yeah, I think like what we help with at Coolwater is, some of that fund product packaging, like helping understand fundraising strategy, um, business building, again, fund management, business building, that's a separate skill set too. That's
Yep.
not investing. So like maybe there's some concentric circles here, but that's not investing. That's not even fundraising. Like again, it's a little bit concentric circle, but like business building is like something different. And that can be like you being a good business builder as a VC and like helping the businesses you're investing into and like you're, like creating operating leverage through your like business building skills to help your, portfolio startups, or it can be business building at like you building a great business as a VC fund.
Right.
But I'd argue like the best people have built unicorn companies and have come through Coolwater. They do it somewhat, but it's almost like a pastime where they like think about building their asset management firm or their VC firm with their
Right.
business building skills. Again, it's more focused on like value add, which might be another pillar, right? Like investing, like fundraising, like value add is another pillar where it's like if you have that skill set, like if you've built companies before, can't like then you go to your portfolio companies, you can give the right advice,
Yeah.
right? And I think there's this underlying kind of theme of Silicon Valley, which is like you've seen especially kind of on the rise over the last kind of 10 plus years, which is like operators give better advice,
Yeah.
right, on how to build businesses.
Yeah.
Maybe not better advice on like governance or
Hmm.
fundraising, but definitely on like I've been there, done that. Here's one way to think about it, right?
Yeah.
And so yeah, there's all these like different dimensions of I think what makes a successful VC, able to fundraise in the best environment and today's environment.
Yeah. It's been kind of interesting too with the best environment. Harry Stebbings has talked about this a little bit. The famous podcaster. That some people who got into this and raised funds realize they don't like it. They're like, there's this sort of view of what venture capital is, and you kind of, for sure, there's guys like this. You show up 2 days a week, and you're in Italy this summer. But it's actually a pretty, I would never call it a hard job compared to an entrepreneur, but you really have to grind. Like it's a lot of work, and you've got 30 companies, and everyone needs something each day, and it's a sales job, really. Like really, you've got to, talk to all kinds of LPs, and like a bunch of people have realized maybe not as glamorous for them as they kind of imagined it when they raised money in 2020 or 2021.
Yeah, I think there's just kind of thinking of a few notes. Like there's probably 5 reasons for that. Maybe there's
Yep.
more. The the first is, and yeah, the way I've seen the pattern play out, again, we meet with thousands of teams thinking about forming every year.
Yep.
We've worked with hundreds through our accelerator. So we've probably met with, this is a slightly grandiose statement, but we've probably met with more emerging managers than like anyone else on earth in the last like 4 years.
I believe it. Yeah.
So a few reasons like why in today's environment, right, it's not the coolest thing anymore to be a fund manager. Maybe I just thought of another reason. So 6 reasons. The first is like it's easier to raise venture capital dollars than LP dollars. So if you're in this ecosystem, right, and your positioning is like, I'm an operator, I've been an operator, I'm a founder, I've been a founder. what's the easier way to kind of get into that business building experience, right? Like it's easier to raise venture capital dollars than LP dollars. That's like maybe one reason. That doesn't say like why you necessarily abandon kind of your fund. Like you've raised the fund and now like you're going back to operating. But I have seen people do that pattern where they're like, I'm a founder. The second reason is fund size. Like I'm a founder, I've been super successful. I could have retired. Instead, I wanted to like raise a fund and, apply my skill sets, right? That value add pillar, apply my skill sets to a bunch of portfolio companies. I think I can affect every fund 20 or 40 great companies versus like if I'm just a founder, I'm going to affect one company. But I only raised 20 million bucks, right? That's a lot of money, relatively across the world. But if you're thinking about it from a business perspective, it doesn't actually give you a huge operating budget, right? To kind of run a, very effective strategy. You're kind of paying yourself and, relatively, you're probably underpaying yourself again, relative to your last job or relative to your last kind of outcome as an operator. And so I think fund size, especially if like you go from a good fundraising environment, like you get the 20 really quickly and you're like, I'm going to scale up to 40 or 50. And then like the math is going to work. That didn't play out for a lot of people. And so, they kind of said, oh, I'm 20 and now I got to go to 15. I don't know, like the math really doesn't work anymore, especially if you're multi-partners, then you kind of have that tough conversation of like, I still like you, but this doesn't add up. Like the math just doesn't add up for both of us to be at this firm, right? Like we can't keep paying ourselves like, ramen wages, like, and make it work. And again, venture's weird. Like they might still be incredibly successful 10 or 15 years down the line. Like their investing skills might validate why they're an awesome partnership, but LPs aren't going to kind of like save you in the near term. Like 2 years in when you're still in the J curve. And like, again, venture's weird where I've evaluated funds and I'm just like, oh, this one hurts to kind of re-up in. Right. And then, 5 years later, some random portfolio company you didn't even know was going to be the unicorn emerges and like saves them. Right. And so,
oh, somebody just published, I didn't interrupt, but really interesting. I forget who published this, but every fund's in the top quartile somehow when you get the deck. But they published a thing like in year 6 or 7 or whatever, they kind of think the quartile stabilized, that the top funds had actually been in every other quartile over time. They'd been in the bottom, they'd been in the middle, they'd been at the top, they'd been all over the place. And then the unicorn had emerged in year 4 or 5, and then they ended up being the top quartile or top decile.
Yeah, so that's kind of a funky dynamic where, again, it makes it really hard from the LP side. I had a former colleague that always say like, man, as an LP, your job is harder than my job as like a VC. He's like one of the best kind of VC investors I've ever known. But he's like, he'd always say like, oh, it's so much harder to be an LP. Because like these things where you're looking at a company, it's like, okay, the product kind of is working. They're generating revenues, like the metrics kind of, line up. Great, I'll make the bet, right? Still might go to zero, but there's more like data you can actually bet on. Where an LP, you're like 2 years in, doesn't seem like anything's working at this point in time. And now I got to write like another few $1 million in this fund. Like, oof, like, okay, I guess I'll have faith, right? It's like a harder bet to make because of like less data. The other 4 reasons, just quickly, right? Like sourcing, you're always trying to find your next best, right? It's like, you can basically have, a 3-minute champagne party and then like you have to go back to work and like you're only as good as your next best deal, right? So you're always on. It's like, great, yeah, you can spend your 3 months in Italy, but like you better have a really good strategy for sourcing your next best deal because you're probably not going to find it like when you're vacationing around the world. Maybe you will, right? Like there's definitely great VCs from the best VC funds in the world that vacation Italy and greater Europe or have spent like years in Europe for their children's benefit, who've like sourced great deals over there. Those are facts, but like I think the sourcing piece kind of grinds, to your point. The portfolio management piece, right? All of a sudden it's like, great, I'm going to be an independent VC and like I'm my own boss, but it's like, no, your bosses are your LPs now. And like they're going to want information. And so portfolio management means not only are you sourcing your next best deal, but as your portfolio grows, you've got to manage the portfolio and add value to the portfolio and collect data on the portfolio and report to your bosses, your new bosses, your the limited partners of your fund. And then multiple funds, more complexity. This is one of the reasons why we started an OCFO business for funds, because when you get to fund 2, fund 3, the complexity grows, right? And so it's like who is there helping you figure out the portfolio management side and the kind of the data organization side and the reporting to LP side, taxes, audit, name your favorite kind of process as a fund manager. Um, I think some people like maybe get disillusioned by what business they are building. It's just not, it's like asset management,
Yep.
right? Who do you want to manage your money sometimes? Right?
Hmm.
Like the super pizzazzy person that's going to the party and like, it's like, or person that's just like, I'm very conservative and like, I'm not going to lose your money. And like, right. Like I think it's almost like human nature sometimes to opt for someone where it's just like the business of building an asset management firm maybe is sometimes sleepier than the excitement of building kind of another type like a venture backed business.
Yeah.
And so again, I think there's that pull back to like you've seen some people that where they discover kind of the new thing in their portfolio. They'd be like, oh, I want to be a fund manager. All those other things kind of add up. And then they're like, but no one, like, I can't find the company I want to invest into. I've seen this a couple of times, right? And they're
Yeah.
like, this company needs to be built. I need to build it. I've invested into 40 companies, but like no one's building this 41st company that I've been looking for since company one. And so I
Yeah.
see that dynamic play out over the last kind of year or two, and they don't raise a
Hmm.
second fund. And I've been surprised because some of those people absolutely could raise a second fund or a third fund and they could step up as well. They're like that good, but it's just, again, it's a pull, right? Like it's an itch where they need to get back to, business building in a different form. And then the last one related to the LP is like you're fundraising all the time.
Right.
So maybe that was your point on like the sales side, but you're thinking about it as like, oh, I'm going to be like interfacing with the best, coolest technologies. I'm going to be in the weeds and like helping like build the next SpaceX. And then all of a sudden you're like, wait a minute, like 80% of the job is like fundraising.
Yeah.
And so I think that's another thing where you're like, wait, I thought it was something like meeting with the coolest technologies in the world that are going to change the world, but it actually is just like meeting with a bunch of LPs and figuring out how am I going to raise my next fund. So I think those are like different. I think those are like
Yeah.
misconceptions almost of like when you get into fund management versus like when you're actually in fund management for a while. Like I think, yeah, some people over the last few years, they jump into it because the market environment makes sales really easy. Fast forward 3 years, they're just like, I've got more perspective now. Some
Yeah.
of this stuff doesn't add up to what I actually want to do with my life.
Yeah, I think when you come into it, if you're a founder like I was, what you don't realize is it. And I have a friend who teaches at Stanford, and everybody wants to be a VC, and he says, ask them what skill sets they think they would use the most, and like analysis, and I'll be in helping the companies, and he's like, no, it's sales. Like it's like 90%, convincing a company to take your money, convincing an LP to give you money. It's basically a sales job, and then it's nothing happens in the job compared to a company. So every day you wake up and you need to talk to more LPs and you need to meet more companies, and that's really cool. Like the LPs are really interesting people. The companies are doing amazing things, but it's not like a company where you're like, oh, we have $1 million in sales, and now there's a new team, and now there's 100 people here, not
Yeah.
50 people here. It's just get up and do it again, and do it a little better, and do it a little better. But that's it.
The people going to Italy might be onto something where it's like patience maybe is the greatest virtue of venture capitalists. And so like forcing yourself to go on vacation probably affords you the patience to like, not have to do everything, not have to do something every day.
Yeah.
Maybe that's the way to think about it.
What so how does somebody come into Cool, and then I'll ask you a couple of things about the market in general here, but how does somebody come into Cool? Like how does your business work? Like you talk to thousands of people. Is it a class that you get to join, or how does that work?
Yeah, so we have a very large kind of top of funnel. People are, inbounding from the different events we're doing. Like we're doing a multi-hundred person demo day, for example, in New York next week. So a lot of people, like I think we have over 1,000 applicants into that event alone.
Oh, wow.
And so like, people come in that way. Not all those are GPs. There's some others. There's a bunch of LPs. But like again, it's inbound. We do a bunch of other events like salons, happy hours. People inbound from that. I think our brand has grown a little bit, so we get inbound from that. We get a lot of inbound from like word of mouth, right? Like, oh, my friend is kind of spinning out of this company, or they've been angel investing for 10 years. Like you should talk to them. We try to give everyone 30 minutes, right?
Hmm.
If they're qualified. So that means we end up taking, easily 700, if not 1,000 calls a year. Like
Wow.
that's an exercise in and of itself.
For sure.
But we try to like meet with everyone, just like, okay, what are you doing? Like, where are you in the journey, right? Like, what are you struggling with? And yeah, can Coolwater like complement in some way? And
Yeah.
so again, like the ways we've historically kind of complemented managers, one is like, this program that helps kind of package thesis strategy, kind of performance narrative, right? It's like, what's the fun product you're creating? Just to, like, it's almost like you can just read my book and like it probably gives you the same thing, but it's, the idea is like, is there something here to actually go to market? Right. So we've run that as a program in the past. The core program is like, you've got the, semblance of the fund product, come through and launch your fund. That could be a fund one, that could be a fund two, that could be a fund three. You're an emerging manager. We can be supportive. You're going to get the comprehensive playbook. You're going to get like an understanding on, again, fiduciary responsibility, fund management, portfolio management, all the boring stuff that goes into the job that like is necessary for you to raise institutional capital, come through the core accelerator. And then there's like this huge community and capital network around that, right?
Yeah.
Again, similar to another accelerator where you go in as a company and you're expecting to get introduced to a bunch of investors like through events or bespoke. I think it's kind of the same concept of come into this very focused ecosystem around emerging managers where if you keep that high signal, LPs pay attention to that.
Yeah.
And then we broke out a lot of like the finance and the operations from that just based on cohort feedback where people are like, the existential part is fundraising, right? Like I need to get
Yeah.
up, I need to get my fund off the ground. And so again, when I'm like, the old grandpa in a rocking chair, kind of telling people that finance and operations is important and the operational due diligence process, right? Just rolled my eyes and fell asleep 3 times saying that out loud. Like that process is like important to emerging managers. They just don't really care, but they should care and they will care at some point,
Yeah.
maybe a couple years down the line where they're like, yeah, I kind of need to do this. This is a pain in my butt. Or, I just know like, I'm trying to make that jump to institutional and I need someone that's been there, done that, been the CFO of private equity and venture capital firms. And kind of that's what we've built with that offering, right? So again, like top of funnel is big, comes in from a bunch of different ways. And then we try to think of like the journey of building an investment firm and like how can we complement,
Yeah.
right, in a systematic way so that it's effective, it's not disorganized, it's effective. When like you interface with Coolwater and you like come through one of these programs, like you're coming out the other end, you're going through the gauntlet, you're coming out the other end, like the result is something like efficient, effective, systematic, institutional, right? That's how we try to like, again, take the emerging manager market, the quality that's in the emerging manager market, and say like, hey, if you want to work with us, we're going to systematically help you like improve, right?
Yeah.
And it's a very like practitioner focused, results oriented like culture and strategy.
Yeah. And how's it going? I mean, you started a business, you had an idea about what's supposed to happen. How's it going? Like, how are you feeling? You're like, oh, I'm on to something. This is great. Or, okay, a couple adjustments here.
I don't know. For anyone that's ever run a business, how's it go every day? Um,
Yeah.
I think, sometimes it feels like it's going well. Sometimes it feels like it could be going better.
Yeah.
Um, I think, we've had some, impressive results. We've, successfully helped over 200 funds, launch their funds. They raised
Wow.
over $4 billion.
Wow.
They've invested, this is prior track record as well as existing track record into over 8,400 companies. That makes us one of the largest accelerators in the world by like number of portfolio companies of our,
Yeah.
constituents. Um, we just announced a couple weeks ago that we're launching the accelerator internationally in Tokyo, right?
Oh,
So we have government interest and corporate interest in this model, and so like that seems to be going well. We have treasure troves of data. There's a lot of people kind of paying us for the data,
yeah.
to leverage it in different ways. And so like benchmarking, right? Like how do you kind of think about what the market is and how I should think about this? And if you don't have a team, right, investing actively or understanding kind of what emerging managers are doing or like how to benchmark emerging managers, like we can kind of support from that end. But yeah, the accelerator seems to be working. We're building the OCFO business. The accelerator is expanding internationally.
Yeah.
We, we'll continue to build what we view as, and this is kind of a mercurial word, but like solutions for the emerging manager market.
Hmm.
And again, it's like the original vision was platform. I don't think a platform is a one trick pony. It's like you look at, I think, objectively the problems of a certain part of the market and you say, what is the most efficient thing to build and like the
Yeah.
most effective and impactful thing to build? And that's what we've tried to do. We've tried to like, again, we meet with potentially more emerging managers than anyone else on earth, as I alluded to, like, and people can feel free to kind of like challenge that in terms of number of calls or number of top of funnels, but like the idea is like because of that, and maybe even if we're just like top 10, we see so much data on like what people's problems are.
Yeah.
And it's not just like we look at it and be like ha ha, right? Or we look at it and say like, yeah, that's too bad, or we look at it and say like, someone should solve that. I think the culture that I've tried to build, right, like where I've gone through that process historically and just said like, who's going to build this, like, thing, who's going to build this platform? But now it's like Coolwater represents the solution,
Yeah.
right? So if I see the problem, I'm like, dozens if not hundreds of people are suffering that problem. And right, it's like, okay, like if your data isn't correct, if your LP reporting isn't correct, right, if you're tripping up on kind of your operations, hundreds of firms, like some people are just like, that's too bad, or that's the state of the market. Where I think that the Coolwater culture is like, okay, let's go to the drawing board, right? Like, what is the thing that we could
Right.
potentially build that's very effective and scalable, right? And kind of positions us as this, number one value added LP,
Yeah.
right? And that's kind of that's what I think the reputation we want is. And it's very hard to do. It's very
Yeah.
expensive to do. But like
Hmm.
that is kind of what we're going after, where it's
Yeah.
like, if we identify a problem, and again, I think a lot of people are then like, their next question is, well, what's your cause then? Like, why are you doing this? Like, who cares about emerging managers? Well, performance wise, first and foremost, if you're an investor, they represent, right, like a really interesting kind of potential performance in a portfolio. But, bigger picture, right, the innovation economy, right?
Yeah.
Look at all the established firms. What do? They write personal checks or they carve out a part of their fund to do fund to funds to invest in emerging managers. These are the smartest venture capitalists in the world.
Right.
They are all investing into emerging managers, right? So it's
Yep.
like, why aren't more LPs investing into emerging managers if all the smartest investors who are the insiders of Silicon Valley are investing into emerging managers, right? So
Hmm.
an incredible performance thing, but also like they represent kind of great sourcing and a great kind of I think financing engine for the innovation economy. And so if
Yeah.
you lose that emerging manager thing because interest rates are higher or whatever the reason, right, at a macro level, if you lose emerging managers, you lose a critical part of the innovation economy and America's competitiveness
Yeah.
for driving forward technology development. You don't start investing into a company at pre-IPO.
Yep.
You
Right.
start at the pre-seed and the seed. You start at the first round of capital. And so it's like, who is supporting that first round of capital,
Yeah.
right? In more than just like, here's a check, go figure it out, come to me in 15 years and give me my money back three
Yep.
times. Like it's a different, right? It's like our approach again is
Yep.
value first versus like, here's a check, go figure it out yourself. It's like, let us co-found this business with you and help you figure it out. It's your business, right?
Yep.
We're just your partner. And like, we want you to be successful because you represent such a critical part of, the economy.
Yeah. That's fine. I mean, to wrap up a little bit, I'll just ask you on the kind of macro. We've sort of what you see next. We had this sort of infusion of capital, easy money. A bunch of people started funds. You then had that stop, coupled with or because of kind of the M&A markets dried up, and the IPO markets seem closed, and so there's just aren't at the moment returns. Everybody's got their fund branded as something trying to attract interest. I'm investing in the future of the aging of America or defense or whatever people are trying to do. And then you have AI coming into this. Like, where do we go from here? Like, what the hell is going on? Like, it just seems like every factor is turned to 10 right now in some sense.
Yeah, that is a great observation. There's a few points in there. One is like, what's your favorite, buzzword, concept, buzz phrase of, the day or the week or the month or the year. So again, when you're fundraising and you're trying to kind of, be as salesy as possible and as attention grabbing as possible, like, yeah, you throw out the like longevity, defense, AI, right? Like
Yep. Sure.
climate. Um, So there's definitely that going on. So what does that mean from an LP's perspective? From a VC's perspective, it's like know the rest of the market. How are you strategically positioned? From an LP's perspective, it's like going that layer deeper and like, okay, your climate, what does that actually mean? Like
Right.
what, like how are you actually defining that? Right. And so it's like figuring out a little bit more like the insight, background of the team, kind of what the strategy is, what the portfolio will end up being, right? Especially if you're betting on a blind pool. So I don't think that goes away, right? Like I think people are trying to hone in on the biggest opportunities. I think defense is like that falls under deep tech, longevity falls under deep tech, AI might even fall under deep tech. And I think these are like cross-disciplinary, complex, many times complex, more complex than enterprise SaaS like businesses from a business model perspective, and sometimes from a, many times from a technology perspective. So I think, what's happening, right? It's like in real estate, what they call like the path of progress. It's kind of like what's the, path of VC investing, right? Like, and the VCs are like, okay, what is saturated? Maybe it's enterprise SaaS. And therefore it's like, where's the opportunity? Where do I carve out the opportunity to position myself so that I look different? Right?
Hmm.
Like the different is better than better concept. It's like, I need to look different. So what do I go after? And like, am I a genuine enough team to do that? And if, some of those are successful, right, then, people kind of pour in and try to, take away, I think, the economic rent of that particular opportunity. So
Hmm.
that's, and it's much easier to set up a fund and to raise a fund and to advertise a fund, I think, in the last few years, like definitely over the last decade. So you have a lot of easy ability to kind of like get into market very quickly and kind of raise. And like I said, like we're going to talk to 2,000 funds this year. 2,000 funds aren't going to raise in the US.
Right.
A couple hundred are. So there's going to be a huge attrition rate. So people are almost like throwing their hat in the ring, being like, well, I'll buy a lottery ticket and like see if I can raise the fund. I think I'm like positioned well enough. So I think
Right.
there's a lot of that going on. And that
Hmm.
makes it look, I think that makes the market look more saturated. But I don't think that goes away. Like, and there's like, as long as I've been doing venture, there's always some like buzzword that people are kind of, you'll see the most amount of pitch decks reframed
Hmm.
for, whatever it is, like in that 1 or 2 year cycle. That could be enterprise versus consumer. That could be like how are you integrating, blockchain. That could be how are you kind of integrating AI. Like there's always kind of like something like how are you integrating like the SaaS kind of business model. There's always something that feels like where if it seems like LPs are going to bet on it, then like the VCs kind of like frame it to their advantage. Um, there's a lot of funds. There's a lot of attrition going on,
Yeah.
right? I think I said maybe sometime earlier this year where, I can see over 50% of the current funds, like to our earlier conversation, just leaving. Doesn't
Hmm.
necessarily mean they failed or they're not going to make money. Like, I just think it means like they don't continue to be fund managers.
Right.
They go work at a corporate, they merge with another fund, right? They go work for a bigger fund, they go start another company, right? They just kind of walk away and decide like, yeah, I could have retired at my last thing. And like, this just isn't worth kind of the cycles. Like you saw a lot of prominent VC firms kind of just turn into family offices, I think, over
That's
this,
right.
last cycle as well.
Hmm.
Cause they're just like, I don't really want to like do this anymore. I've been successful enough. So I do think you see that play out. And like, that's what I'm seeing. That continues to play out. I've been surprised at the continued fund formation, just how many people want to raise funds.
Hmm.
And it's definitely become more competitive and sharp elbowed in the
Yeah.
last year
Yeah.
than it was even 3 years ago. Because it felt like, oh, there's so many LPs and so many new LPs. Like I'm getting my $20 million fund and this person's going to get their $20 million fund. But it's become like more sharp elbow now. It's like, are you gonna have another climate fund kind of at the same event? Like I want to be like the only climate fund there. And
Yeah.
so kind of seeing that, which I don't know if that's necessarily good for kind of growth mindset and kind of the growth of the industry. It's an obvious dynamic, right? But I feel like the competitive dynamics are greater from my perspective today than they were, 2 years ago,
Yeah.
or even a year ago. And then I see like the last point maybe is just like the pickup in like secondaries are
Hmm.
massive. And so this is smart, established VCs selling a lot of their portfolios, working with their existing LPs, right? The pickup of secondary funds. There's a lot of that going on. And then, yeah, I think trying to be maybe the first to call it, but this kind of new asset class of like AI driven companies. Like maybe it's the new growth equity, but it's like venture used to be part of private equity, and now it's like its own asset class,
Right.
right? It's like it went from cottage to mainstream and became its own asset class, when before it was like the last paragraph in a research report on private equity. And I think like with AI, like it actually feels like, again, this is very early and it might be false, but it feels like there's a new category of like AI driven companies, like the new growth equity kind of being created. And like
Hmm.
it's a different structure, it's a different duration, it's a different strategy where like if you invest in a buyout fund and you invest in a venture capital fund, those are two different strategies, different return drivers. How you make money is very different. And
Yeah.
what you're selling is actually different. And I feel like there's a category emerging of like AI kind of driven like growth equity businesses, fund managers that yeah, just it's interesting. It's
Yeah.
interesting to see how like how that plays. It's almost like the search fund industry is evolving,
Yeah.
and like the private equity industry is like converging, and like the venture capital industry is like driving kind of the ability for this like new asset class to emerge. And I'm
Yeah.
seeing that recently. So heard it here first, maybe.
Yeah, that's right. Well, it's definitely a dynamic time in the market. I really appreciate you doing this. How do you want people to find you, or find Coolwater, learn what you're
LinkedIn, super
doing?
easy,
Okay.
right? I'll definitely respond if you reach out there. Feel free to send a note with the connection request.
All right, this is great. Well, thanks so much. This has been something ventured podcast. Winter Mead, my guest, founder of Coolwater. Talk to you next time.
Thanks, guys.